take over and have business live. But Ian, this will be a story top of the agenda for the show today and this afternoon.
Well, I'm sure, Wilf. I mean, the truth of the matter is there was an air of inevitability about this announcement. The Tata Steel operations at Port Talbot were losing more than £1 million a day. Inaction was not an option. Something had to be done. These businesses have been competing against incredibly cheap Chinese competition, for example, with the hand tied behind their back effectively. The councillor there mentioned the fact that there is a move and a desire to go towards greener operations, greener steel. And that is something that European steelmakers are going to have to do as well at some point in the near future. This isn't just a UK problem. It's worth pointing out in passing that the operations at Port Talbot are the biggest single CO2 emitter in the UK. And there's been a move by governments of both colours, both Labour and Conservative and the Coalition, towards moving away from energy-intensive and CO2-intensive industries. And this announcement, this strategic announcement from Tata Steel is part and parcel of all that.
Ian, I will hand it over to you because I know there's a very busy rest of the agenda on the business side.
OK. Thanks, Wilf. On to other business news now. And UK retail sales volumes fell unexpectedly sharply last month, raising concerns that the economy may have ended 2023 in a mild recession. The Office for National Statistics said that sales volumes in December were down 3.2% from November. That was worse than the 0.5% drop that economists had been expecting, and it represented the worst monthly fall in sales volumes since January 2021, when the last of the UK's 3 national COVID lockdowns was imposed. Well, within that, non-food sales volumes fell by 3.9%, while food sales volumes fell by 3.1%. It all meant that for the year as a whole, sales volumes fell by 2.8%, making 2023 the worst year since 2018. Joining me now is Erin Brooks, European Retail and Consumer Lead at the consultancy Alvarez & Marsal. Erin, good to see you this morning. I mean, on the face of it, these are pretty bad numbers, but when you put them together with the November numbers, which were revised upwards today, there's a more nuanced picture taking place here.
Indeed, Ian. I think the numbers that we've seen for December have really been quite surprising for retail management teams. Not only have they been the largest month-on-month drop since 21, they've also been the largest reduction in volume since 18. So that in itself, if we're looking at December, is a fairly bleak picture. November was a little bit more positive for retail businesses, and we can see the effect of Black Friday, or as many are calling it these days, Black November, succeeded in pulling some of the sales forward into November. But we're usually used to also having a significant bump in December, which suggests that consumers really thought hard about how they were spending over the Christmas period, and it simply didn't deliver in December.
Yeah, I mean, anecdotally, a lot of retailers have been saying people did shop early this year. There was a lot of promotional activity in November, and certainly on the non-food side, but even on the food side, that was significant.
Absolutely. What we can see from consumer behaviour, which is hugely impacted by the cost of living crisis, by concerns around increasing cost in rent, cost of all utilities, etc., is that consumers are being more selective and planful about their activity, and we did see food pull forward into November. And I think the other interesting thing here is that discretionary category in non-food is suffering and continuing to suffer as consumers decide very selectively where to spend.
What I struggle with, Erin, is how we reconcile what we've seen today with some of the trading updates that we've had. I mean, Tesco, Sainsbury's, Next, Marks & Spencer all did incredibly well. Some of the other retailers not so badly either. There have only been 1 or 2 really bad trading statements. Superdry comes to mind, and JD Sports. Apart from that, it's been pretty strong.
I think we need to wait and see how the rest of the trading statements roll out. But we have seen incredibly strong trading at Tesco, like you mentioned. Next as well has updated their profit guidance, very, very strong. But this, Ian, is a real polarization in the market, and we're seeing businesses that have a real pull, that have a distinctive and differentiated offering, and that are strong in food with exceptional performance. The other interesting one that we saw this week was, of course, Watches of Switzerland, who issued a profit warning to me, this kind of reinforces the story about those discretionary items really not being where consumers are investing at the moment.
Yeah, and indeed, the ONS in this statement says that sales of watches and jewellery have been quite weak. But it does appear that there's been strength in some other categories. I mean, we had Currys on the programme this time yesterday. I mean, they beat expectations, albeit their like-for-likes were lower, but they've retained their margins.
And I think they're working very hard at that. The other category that we were pleasantly surprised was not as poor as it could have been was clothing, actually. So still, I think, people wanting to enjoy time with families, celebrate and invest in clothing. Also, the weather has been quite terrible in December, so that may have helped the category. But reality is that retailers will be working very hard to figure out their plans for next year, when actually there are very few things to grab onto as green shoots in terms of how the consumer is feeling and how they're spending at the moment.
Briefly, Erin, would you expect to see a rebound in January?
I think it's going to be challenging. We have consumers really worrying about the fact that house prices are dropping by around 2%. Rent is looking to increase this year of around 6%. This, for me, does not really play into a situation of confidence. We do have minimum wage coming up by, I think, to about £11.44 in the next year, which will, of course, hopefully provide some boost to households that are on where they depend on minimum wage. But that also impacts retailers' operating costs. So property tax costs are also going up. I think it's it's going to be a tough start to the year, which means that we'll be seeing lots of consolidation in the market. I think some distressed M&A and also potentially some restructurings.
Interesting. I would have loved to have asked you more about that, but we're out of time, I'm afraid. Erin, good to see you this morning. Thank you. Some other stories for you now. And the logistics company Wincanton has agreed to a takeover by French rival CMA CGM for £566.9 million, or £764.9 million, including debt. Wincanton, which employs 20,300 people, including 5,000 drivers, provides logistics services to customers including B&Q, Halfords, Asda, Primark, Wickes and Waitrose. It was founded 99 years ago and was originally part of the West Surrey Central Dairy Company, a business that eventually became Unigate, from which it was demerged 22 years ago. DFS said today it expects to report a slight increase in half-year profits despite suffering a drop in orders. The UK's biggest retailer of living room and upholstered furniture said its order intake in the half-year to Christmas Eve had been down 1.1% on a year earlier, but insisted that meant it had outperformed a challenged market. It said this was partly due to record hot weather in September and early October that had hit visits to its showrooms, adding that it had since seen a recovery in demand. The shares are up 1.5%. And the property company Custodian Property Income REIT is taking over its peer Aberdeen Property Income Trust for £237 million in the latest in a string of deals in the sector. The combined business will own a portfolio worth more than £1 billion, comprising more than 200 properties, including industrial warehouses, offices and retail outlets occupied by the likes of Morrisons, Greggs and TK Maxx. The pair said that joining forces would create a more diversified business well placed to find and invest in misplaced assets. Now, consultation by the energy regulator Ofgem on standing charges closes later today. The standing charge is a daily charge paid to energy suppliers to cover fixed costs such as wires, pipes and cables, as well as staff and buildings, and it's levied regardless of how much energy a customer uses. But it's attracted criticism because it has doubled over the last 2 years at a time when increasing numbers of households are struggling with their energy bills. Well, separately, the British Gas Energy Trust, an independent charitable trust founded by British Gas for the last 20 years, announced today it's received a funding commitment of £20 million from British Gas to help households with their energy costs. Well, joining me now is Chris O'Shea, the Chief Executive of Centrica, the parent company of British Gas. Chris, morning to you. Good to see you. We'll get on to the Energy Trust in a moment, but first, I'm keen to know what you've actually said yourselves to Ofgem about standing charges.
Yeah, so Ian, firstly, thanks very much for having me on. In the middle of last year, we made a call for standing charges to be abolished and for the way that we recover costs to pay for things in standing charges like network charges, etc., to be put on the unit cost. And what that would mean is that those customers who use the least amount of gas and electricity would pay the lowest amounts. At the moment, the standing charge is about £300 a year. So even if you use no gas, no electricity, but you have both connected to your homes, you pay about £300. So we've been calling for this for a while. We have been very clear in our response to Ofgem's consultation that we think these charges should be abolished.
So this would effectively move to a more progressive pricing structure under your proposals?
It would absolutely, yes. So it would really all be in the unit charge. But what we've also called for, it's not in this consultation, is a social tariff, which means that those people that need most help get most help. So they would pay a lower rate for their gas and electricity, and those that could afford to pay more would pay a higher rate. If we could do both of those things, abolish standing charge and introduce a social tariff, then we'd really be doing a lot to help those people that are most in need.
Would you envisage that the price cap would remain? Because at the moment, standing charges are subject to the energy price cap.
Yeah, look, I think that the price cap is not perfect, and we've seen some really bad outcomes over the last couple of years, not just of the price cap, but of regulation. As energy companies collapsed, 4 million customers had to be moved from one energy company to another. And everybody in the UK is paying £88 to pay for the cost of those failures. So there's undoubtedly been some failure in regulation. Ofgem's improved some of the regulation since, but I do think price regulation has been a positive for consumers. And whilst changes could be required, I don't expect the price cap to disappear.
Now, separately, Chris, Ofgem has allowed some suppliers to restart involuntary prepayment meter installations. Not you, we hasten to add, but is this something that you would like to see British Gas doing again?
So what Ofgem have done is they put a new regulation. Well, as an industry, we signed up to voluntary, stronger regulation, and 3 companies have applied for permission to restart the installation of prepayment meters under warrant. We haven't applied. What we've done is, since we had problems last year, we brought all of the work in-house, spent a lot of time and a lot of money on training our people, on making sure our policies and procedures and practices were up to date. But as of now, we haven't applied to restart the installation of prepayment meters under warrant. But what we have seen is an increase in our bad debt. So what we're always trying to do is to balance the support that we give to our customers through financial support, through the £100 million that we put into our voluntary support fund, the £20 million that we've announced today for the British Gas Energy Trust. We try to balance that, but also with a desire to not let customers run up debt that we know ultimately they can't pay, because that has huge implications on their life, huge implications on mental health. So what we need to do is to find a balance, but we need to lift it above just the energy conversation, because what we have is people that are struggling to pay their energy bills, to put food on the table, to pay their rent, pay their mortgage. And we as a society need to say, how do we help those that are most in need, which is why we're calling for the abolition of the standing charge and why we're calling for the introduction of a social tariff.
You mentioned just now that you've seen an increase in bad debts. I know you've got figures coming out, so you may not be able to tell me. Can you give me an idea?
I can't tell you exactly how much, but it's a substantial increase. It will be a 9-figure sum in sterling, and we've seen an increase in bad debts as people have been struggling to pay their bills. It has been expected, though, because as you've seen inflation come through the entire economy, cost of everything has gone up. So it's not entirely unexpected. It's something we can cope with as a company. But what it does mean that every pound increase in bad debt is a debt that customers are worried about. And that's really where my concern is, which is how do we help those customers stop getting into debt, because it has such a negative impact on their life and on their mental health and the stress levels and on the worries. So that's why we put this money into the trust, because what the British Gas Energy Trust does is absolutely incredible. It's not just debt relief. They will also do debt counselling, financial counselling, to help people hopefully avoid getting into debt in the future.
Does one have to be a British Gas customer to benefit from the work of the Trust?
No, so the British Gas Energy Trust was set up 20 years ago, and it will help customers of any energy company. Now, what we've done through our £100 million voluntary funding packages, we put extra funding in, some of which has been administered by the Trust. A lot of that extra funding is for our own customers, but the standard funding that we give to the Trust, and we've given more than £200 million in the 20 years that the Trust's been existing, the standard funding will help any energy customer.
All right, Chris, we have to leave it there, I'm afraid. Good to talk to you this morning. Thanks very much indeed.
Thank you, Ian. Thank you.
More now on the breaking news this hour. And Tata Steel has confirmed that more than 3,000 jobs will go at its steelworks in Port Talbot. Our business correspondent, Adele Robinson, is at Port Talbot. Adele, I gather we've just had the official statement from Tata Steel.
Yeah, they've given a little bit more detail on the numbers, actually. They've said that basically 2,800 employees are expected to be affected, and out of that, 2,500 roles will be impacted in the next 18 months. In the statement, they've basically said that they're commencing a statutory consultation, of course, because of these job losses. And they also state that this is about reversing what they describe as a decade of losses and to transition from the blast furnaces to a more sustainable green steel business. That's in reference to installing an electric arc furnace. They also say that it would, and this is important, would secure Tata Steel UK's existing product capability and to maintain the country's self-sufficiency in steel making. Now, that's something that the unions particularly argue against, saying that actually this makes us more vulnerable on the world stage with regards to the steel market and having to be reliant on importing. But the bottom line really is that this feels like a final decision. Unions feel differently. They will be not taking strike action off the table. They say they're going to be fighting for every job.
OK, thanks, Adele. Still to come here on Business Live, we'll have a look at how the markets are doing this Friday morning. Stay with us.
Big stories don't always come from big cities. I'm Lisa Dowd and I'm Sky's Midlands correspondent, and this is where I grew up. We can reveal that the driver who hit Harry Dunn is 42-year-old Anne Sakulas.
Just met the president and we never thought we'd get this far.
This is what they're up against, that the wind is the really big problem. It is back-breaking work and the smoke is thick. It's been working well. Water levels are dropping, but no one knows what impact further rain will have. What would you do if this place wasn't open? We take you to the heart of the stories that shape our world.
It's really scary. We're terrified.
In this community, I'm told that everybody knows someone affected by COVID.
Hopefully this will be the last wave.
I never knew they would make it. It's amazing.
Change seems tantalisingly close in this corner of the UK. Wales was the first to introduce the plastic bag charge. This is my patch, my specialism. It's also my home.
I just took a shower above the clouds. You know why? Because this is the Emirates A380. Fly Emirates, fly better.
pound has fallen on the weaker than expected retail sales figures. Sterling currently off by just under 1/5% against the USD. In fact, it's down 1/5% on the now down 1/3% against the euro. The dollar, meanwhile, on course for a second consecutive weekly gain against a basket of currencies. On the equity markets, last night's gains on Wall Street, which saw the S&P 500 finish just 0.3% from its all-time high, were followed by mixed trade overnight in the Asia-Pacific region. The Nikkei clocked up a second consecutive weekly gain in Tokyo. Well, in Europe, stocks are all trading to the upside as we head into the weekend. Talking points today include ABB, the Swiss engineering giant, off 3% on news that its Chinese operations are under scrutiny from 2 US congressional committees. Well, here in London, the FTSE 100 is also in positive territory just now, up 0.2% in a broad-based rally led by the heavyweight dollar earners. In percentage terms, Flutter is the leading blue-chip gainer. That's after yesterday's trading update, the owner, of course, of Paddy Power and Betfair, while the house builder Persimmon is up on the back of supportive broker comment. Outside the FTSE 100, the advertising and marketing company For Imprint has surged 16.5% on news that profits will be better than expected this year, while Watches of Switzerland has attracted a few bargain hunters after yesterday's 36% fall. Elsewhere, the oil price is heading for a weekly gain amid the cold snap in the United States, although it's lower this morning. A barrel of Brent crude currently trading at $79 on the nail. That's off 0.1%. Joining me today is Sophie Lund-Yates, lead equity analyst at Hargreaves Lansdowne. Sophie, good to see you this morning. Let's start with Persimmon, because, I mean, it's been a weird week for the house builders. They've moved around basically whenever interest rate expectations have shifted.
Hi there. Yes, absolutely. So, of course, house builders very, very sensitive to that interest rate environment because it has huge impacts, of course, on the mortgage rate availability and affordability. Now, what I would say in particular for Persimmon is today quite a cheery way for them to end the week. They've had an earnings, well, a broker upgrade from Morgan Stanley, who are particularly supportive of their exposure to affordable housing here in the UK. We know that there is huge supply constraints, a huge shortage of supply at that end of the market. And Persimmon is set to benefit, really, from growing demand there. So certainly a lot to watch, but they have been a bit all over the place this week, but want to end on a high for sure.
Well, I mean, it's been a mixed week for trading updates, but one that stood out today is For Imprint, an advertising and marketing company.
Yes, so they offer everything. They're kind of logo specialists as well in a big way. So everything from, tote bag, branding, lip balms, that kind of thing, mugs. And they are really doing better than expected. And they have said that earnings for the full year are going to be better than expected. They're seeing sales up about 16%, which is really quite substantial. And the interesting thing here, when we look at the longer run trajectory for Imprint, is that the market really for this sort of advertising is very fragmented. And that means that there's quite a lot of market share for the taking. And also just to say that the dividend is incredibly well covered, which is an area of the stock that I think potentially flies under the radar. And we're looking at kind of more than 2 times covered on an earnings basis. So really quite interesting. I think there's quite a lot of room to run there for them.
Absolutely. Always nice to see a company with decent dividend cover. Sophie, got to leave it there, I'm afraid. Lovely to see you again as ever. Thank you. Well, that's it from me for the time being. I'll be back with the afternoon edition of Business Live at 4:30. Hope very much to see you then. In the meantime, do stay tuned. Coming up next, it's Samantha Washington, no doubt, with more on the breaking news we brought you this hour. That Tata Steel is to close its 2 blast furnaces in Port Talbot in South Wales with the loss of 3,000 jobs. See you later. Cheerio.